Hi, I'll talk about the mortgage-backed securities and the consumer mortgage market. So I'll talk about characteristic of mortgage loan, major players, various risks associated with mortgage loan, key attributes that define mortgages, and knowledge of amortization types, and a lot of other things like how to allocate interest and principal amount for various mortgage types. So start with a very basic term. The mortgage is a loan secured by real property as collateral and may be repossessed by the lender if borrower is in default. A servicer is compensated by lending for collecting the payments from the borrower and forwarding them to the investor. Servicer will also liaise directly with the borrowers in the event of payment and delinquencies of loan foreclosure. Line status. Whether mortgage is first line or second line or subsequent line will greatly benefit the lender's ability to recover the balance owing in eventual of default. For example, a first line would give the lender the first right to receive, process or liquidation, and so from a seniority perspective, first line is more desirable. The second line. Original loan term of 10 to 20 of 10 to 30 years are in common, but more popular being 30 years. That's long term. However, medium term loans are also starting to become common. And we look to the credit qualification. Classical loan between prime and subprime is determined by credit score. That is the FICO model, which is Fair Isaac Corporation. A prime A loan constitute most of the outstanding loan. They have low rate of delinquency and default as a result of low loan to value ratios, far less than 95%. Borrowers with stable and sufficient income, front income ratio of no more than 28% of monthly income to service payments relating to their home, and back income ratio no more than 36% for those plus the other debt, and a strong history of repayment. That is a FICO score of 660. Home payments include interest, principal, property tax, and homeowner insurance. Subprime or B grade loans have higher rates of delinquency and default compared to prime loans. They could be associated with high loan to value, that's 95% of above, and borrowers with low income group, or the borrowers with marginal or poor credit history, that is FICO score before 660. High LTM ratios suggest a higher risk of default upon issuance. Subprime loans are carefully scrutinized by servicer to ensure timely payments. Alternatively, A loans are the loans in between prime and subprime. Though they are essentially prime loans, certain characteristics of alternative A loans make them riskier than prime loans. For example, the loan to value may be unusually high, the LTV may be high, or maybe less documentation available like income verification or down payment source. So, prime, subprime, and alternative. And subprime have higher delinquency and higher default, and they could have been higher loan to value, and borrowers with low income group and a FICO score of less than 660. So, those are some of the qualities of a subprime lender. So interest rate type, we can have a fixed rate mortgage having a set of interest rate for the term of mortgages. Payment are constant for the term and consist of blended amount of interest and principal. Adjustable rate mortgage have a rate change throughout the loan term of the mortgage. The rates are usually on base rates like prime rate or LIBOR plus a spread. The rates can usually change on monthly, semi-monthly or annual basis. The risk of default is high, especially if there is a large increase after the first year, therefore significantly increasing the total payment amount. There are two major types of ARM, that's adjustable rate mortgage, fixed period ARM and negative amortization ARM. Fixed period ARM has an initial set rate that stays constant for relatively long period, and then it can change. There is an initial rate cap as just described, as well as a periodic rate cap that sets a limit of the rate change at the end of the initial period. So there is a life rate cap that sets a limit on the rate that can be charged for the term of the mortgage. A negative amortization ARM has a very low initial set rate and adjusts on a monthly basis, but the minimum payment is adjusted only annually, and there is a payment cap that limits the prepayment increases at reset. As a result, it is possible for mortgage payment to be less than the interest payable when interest rate rise significantly. The loan balance is increased by the deficient interest, thereby increasing in negative amortization. There will be a significant payment increase when it is time to start amortization, the principal payment. Now the amortization type, and all our mortgages are fully amortized in the payment and are calculated as if mortgage will be fully paid off at the end of amortization period. With a fixed rate mortgage, a payment will be constant for the term of the loan. With an ARM, the payment may be recalculated each period based on new interest rate and the remaining principal balance. In both cases, an attempt is always made to set the payment at the level so that principal will theoretically be zero at the end of amortization period. However, there are interest-only payment scheme now being used in the marketplace for fixed rate mortgages. Interest-only payment are required for a set-off period, lockout period. After that, mortgage is reset to amortize the outstanding principal balance. The combination of adding a principal component to the payment and amortization over a short period results in dramatically higher payment amount. The same IO payment scheme is used for hybrid ARM. The term IO and the fixed rate are the same. Similar to fixed rate mortgages, IO aspect could result in significant changes in the payment amount due to increased rate and principal amortization. There is also non-contiguous interest rate only hybrid ARM. The interest only is not the same as the fixed period, and after 5-year fixed rate period is over, the loan is reset and the rate is increased. For the next 5 years, higher amount of interest is to be paid with new rate, and with the 10-year IO is over, the mortgage amount payment will further increase to account for principal amortization. The idea is here to avoid the sudden increase in payment, so therefore we have this non-contiguous interest only hybrid ARM. Then we move to another big domain, that is credit guarantor, and who guarantees these mortgages. So the ability to create mortgage-backed securities require loans that have credit guarantees. Government loans are those backed by federal agencies like Government National Mortgage, GIMA or GNMAC. Conventional loan are securitized by either government-sponsored enterprise like Freddie Mac, Fannie Mac. For a guarantor fee, GSEs will guarantee payment on principal interest to the investor. Recently, cost reasons have resulted in conventional loan being securitized as private label transaction through subordination. Private label transactions also arise because some loans do not meet credit size required by the GSE. Then we have the loan balances. The GSE limits the loan amount that qualify for a guarantor. Any loan larger than the amount cannot be included in the GSE pool and must be securitized in a private label transaction. In general, GSE loan limits have increased over time to real estate appreciation, and there are so many transactions being done through GSE versus private label. Now move to the prepayment and prepayment penalties. Prepayment reduces the mortgage balance and the amortization period. They can occur for the following reason. Home is sold, which requires mortgage balance to be paid off. Refinancing due to lower rate and more attractive loan feature elsewhere. Partial prepayment by the borrower during the term. To counter the negative effects of prepayment, many loan contains prepayment penalties. They are amount payable to the servicer for prepayment with a certain time, and soft penalties are those that could be waived off on the sale of home. Hard penalties may not be waived off. So mortgage loan mechanics. Calculating the mortgage payment factor or the mortgage payment factor applies to a fixed rate mortgage because the principal balance is paid off. The payment amount is constant throughout the breakdown between the principal and interest always changes. So if you remember that very basic graph where your payment amount is fixed, so in the initial part you still pay a higher interest when short small money, that brings down your principal, but as time increases your hit become increasing. So allocation between principal and interest. The mortgage payment consists primarily of interest in the early year. The interest is calculated on the declining principal, and the crossover point is the point where mortgage and principal allocation are the same. The mortgage will be with shorter amortization results in less interest paid. So based on these parameters that we just talked about, which is the allocation between principal and interest, we have different types of mortgages, like for example a fixed rate IO mortgage in comparing a 5-year interest only mortgage to a fully mortgaging mortgage. Both 25-year term, the principal outstanding after 5 years will be higher because in one we have paid off. So similarly we can check out for the ARM, the interest only hybrid ARM, the negative amortization ARM. So for the amortizing ARM, the initial mortgage is calculated on the initial rate for the entire term. For every subsequent rate adjustment, the new payment is calculated and the remaining term. Assuming the rate increases, the mortgage payment should increase primarily to account for the increase in interest payable. In theory, amount allocated for the principal payment should not really change from initially calculated. Then we have the interest only hybrid ARM. Now we look at the risk associated with the mortgage and the mortgage products, and this would be our last topic. So prepayment risk. is of course the biggest risk. When interest rates are falling, mortgage securities holder faces the risk that relatively high rate investment will be cashed in. So they'll reinvestment those funds would generally be possible at lower prevailing rate, thereby lowering overall investment performance. So mortgage with a high rate of interest have prepayment risk because they are likely to be refinanced. Of course, mortgage with low interest have low prepayment risk, and additionally the rate of prepayment will change as interest rate changes, as a result in a cash flow fluctuation in mortgage and mortgage securities. Hedging such investment then become complex and costly. So reasons of prepayment could be many: sale, destruction, lowering prevailing rate, or borrower has defaulted, he has sold the property, and many mortgage have partial prepayment privileges, which is called as curtailment, that he may use, especially when borrower exceed available cash available to do so. Then we have negative convexity. Regular fixed income securities appreciate in value as interest rate decreases. With mortgage securities, however, prepayment rate increases as a result of interest rate decrease, thereby reducing the price. So when interest rate increases, prepayment rate decreases, thereby increasing the relative price depreciation of mortgage security at an amount greater than regular. So it's having a negative uh, convexity. Now we look at the credit risk and the default risk. So the key difference from fixed income securities is that quantifying the characteristic of vast number of underlying loan in a mortgage security, determining how these characteristics will report from performance evaluation, and how to create those best, worst and likely scenarios. So similar to regular mortgages, credit scores and LTV ratios are used to predict credit and default risk of mortgage securities. So if we are in fixed income in company, we used to do all those debt to EBITDA and all those kind of things. Here we'll use the credit scores, loan to value and all those kind of things to predict the default probabilities. Delinquencies, the Office of Trust Supervisors classifies loan as follows: payment due to 29 days is current, 30 to 59 is 30 days delinquent, 90 or more is 90 plus days. So some delinquent may eventually lead to default. Default is most common for loans that are more than 90 days delinquent. Loss severity refers to the amount of loss on the loan after proceeds have been recovered from the sale of the underlying property in the foreclosure proceeding. In general, a defaulted loan with a higher LTV ratio will result in higher loss severity. However, defaulted loan with lower LTV may have losses because the market value of the property is far less than the appraised value. So that was a very small introduction to the mortgage backed security, and we'll continue it from here. Thank you.